Hey guys, we're going to start with business, but like Goff mentioned, throat's not doing well. I appreciate Special for that insight. That's great news. Goff's smiling right now. But yeah, anyways, you guys are going to do most of the talking today. We'll get started with business. So, how was your week in the market? How things fare for you? Just get started.
Yeah, week was good. I bought some stuff. I don't know if we kind of go if you want to go through some of the stuff we bought this week.
Yeah, yeah. We'll roll through kind of like what did you buy, what did you sell, positions you started or added to, and everybody you can run for like, like 8 to 10 minutes each. If you want to go shorter, that's fine, and then we can come back. But that's kind of the layout for this.
Yeah, sure. So as you guys may or may not know, I'm a big fan of selling option premiums. So I sold a bunch of option premiums. I'm doing it currently on stocks like Neo, CCIV. I closed my position early on today on Fubo, and resold a bunch of calls for that expire next week. So kind of just rolling those calls. I started a position this week on Monday in CCL. So CCL, of course, is a Carnival Cruise. I think just that's a good opening play for just as things open back up from COVID and the vaccines become more commonplace and start to become more effective. I think CCL and is a good sort of still has more upside. My price target there is probably close to 40, I would say. So right now the stock is 27. So I know they're in negotiations with the government about how they're going to reopen and how they're going to relaunch ships and this and that. So I think there's like pent up demand there that's still not priced in. Um, Also bought some leaps on a company called Tarian, so it's ATER is a ticker, and they were formerly Mohawk. So they changed their name, they changed their ticker. So that was MWK. So that's kind of a flyer I'm taking on that one. They just got beaten down by a short report that was not. I feel like it was not entirely accurate. And the more that gets exposed as fake, the higher the stock price is going to go. So I like that stock, just kind of as from being in an oversold position. And then I always like to add to my Palantir position. So I've got commons and also leaps open on Palantir. I think in our world these days, more data is always better, and that's what Palantir specializes in. So I don't think you can go wrong on Palantir, even though it's one of those ones that have been kind of beaten down recently. Um, so that's from a growth stock perspective. And then I'm mostly a dividend investor, so I like my dividend stocks. I like to get cash out of my stocks, as we go. So I also added to my position in Q Yield. So that is my favorite high dividend ETF, or I guess I don't know if it's an ETF. I guess it's called an ETF. So if you're not familiar with Q Yield, ticker is QYLD. And what they do is they sell covered call options based on their QQQ positions, right? So they accumulate shares of QQQ companies, and they sell monthly covered calls against that, and they use the premiums to generate a dividend. So I think that was the only dividend stock that I added to this week. So that's sort of my lineup for the week.
So the first question I have is you said you sold calls, and I'm curious about that. One, that can be risky, especially if you're selling naked options. So just get into that a little more. And when do you decide to sell a call option on what stock? I'm interested in
Yeah,
that.
I sell calls on almost everything. I think I'd probably take it to the extreme, but and you probably shouldn't. But in my case, I like to do it. I enjoy doing it. I sell them weekly. So a lot of people they sell 30 to 45 days to expiration, and that's a great strategy as well. I feel like weekly gives me an advantage. Keeps me involved in my portfolio, and I feel like the weekly ones, the stock doesn't have enough time to sort of run away from me. So, the advantage there. I mean, essentially, like if you guys are familiar with what that means, is that instead of when most people think of stock options, they think of buying call options and like betting on a stock is going to go up a certain percentage over a certain period of time. right? So that's how most people use stock options. Well, if you flip it around and you think about it, like options are a marketplace, right? So if someone is buying calls, then someone is selling calls, right? And the person who's selling calls is collecting premiums up front. So when you buy a call option, you're paying someone that premium, right? Someone's on the other side of that transaction selling that option. And for me, I mean, I like it because it's an easy way to just generate extra cash from stocks that you already have in your portfolio. So it's a different way to use options. And I generate income with options in various ways. So that's one is selling covered calls, and then another way to do it is to sell a cash secured put. So in that case, you're betting that a stock is going to go up, but instead of just buying that stock outright, you're essentially buying uh, the diminishing downside of it. So that's sort of a different way to approach it. And then another thing I've been getting into recently are iron condors, which is a sort of my third strategy, and that's a little bit more advanced and a little bit harder to get your order filled. But the idea behind an iron condor is that you're betting that a stock is going to stay within a specific range. So let's say you've got Apple at 120, you could bet, for example, that Apple was going to stay between 130 and 110, right? So you kind of give it a wide berth, and you're kind of just betting that it's going to bounce back and forth. So it's a really good. I feel like we're coming into a good time in the market to use iron condors because things are going to go sort of sideways for a little bit. I mean, growth has kind of been stifled. So this week I sold some iron condors on SPY, and they worked out pretty great. So that's it's a little bit more advanced and a little bit riskier than the other two that we just talked about because you can lose your collateral, but it's yeah, depending on how you structure it, I think they're still fairly safe.
What is that called again? Iron condor. It sounds similar to a
Yeah,
butterfly.
iron
Butterfly.
iron condor, like the metal and the bird.
Okay, I'll look into that. It sounds similar to a butterfly spread. I'm
Very
not
similar.
sure if
Yeah.
you're familiar.
So an iron
Yeah.
butterfly is a kind of you're betting you pick like one strike, and you sell a call and a put against that one single strike. Where the condor you're giving a kind of a wider you're giving the stock price a wider range. So it's
And final,
so it's
yeah.
it's sort of I think it would be like less premium upfront, but also much less risk.
And I want to implore about 2020 after the market lows, when the pandemic happened. I'm sure stocks shot up, so selling calls was much riskier then. Lately, the market's been choppy, so I would imagine selling calls is a lot more profitable now. Did you kind of pause on selling calls, after the market lows?
No, I'm still selling calls. Yeah, it's I sell them pretty far out of the money, right? So you just collect a little bit of premium, and if you so there are two ways to think of it, right? So on growth stocks, for example, that tend to shoot up and have wide, a large beta, so they can go up or down, fairly quickly. I manage that by uh, if I don't want to lose my shares, then I'll buy my way out of a call that's gone bad or gone against me. And then the other way I sort of mitigate the risk is I feel like the shorter your days to expiration, the less the stock has a chance to run up, right? So a lot of people are selling like 45 days or 35-day calls or even a month calls or 2 week. I like to do weekly just because I feel like I've got more control over it. And you can always buy your way out of it if you don't want to lose your shares. And then from the other perspective, like there's for me, like there's stocks I want to keep I'm willing to buy my way out of a call that's gone against me, and there's stocks that I'll wheel, that I'm selling calls that with the intent purpose of being okay with losing those shares, right? So the downside to selling a covered call is that if the stock hits your strike price of the call that you sold, you have to sell all 100 shares that you've written that contract against, right? So that's sort of the downside of it. So I have shares that I want to keep, and then I have companies who I'm buying specifically just to flip and collect premium on. that makes sense.
All right, thanks, business. Take a minute. We had a great spaces earlier with Jonah Lupton. Check that out. And we're gonna have a bunch of great spaces next week, by the way. So make sure you join the Wolf Pack in a pin tweet. Is it still in the pin tweet?
Yeah,
Google
everybody,
Calendar.
you can check out our pin tweet for our shared Google Calendar, our YouTube, our Spotify. We record all of our spaces. We've had some technical difficulties this week, but we are recording this, so hopefully the recording will work. And we're just going to continue putting out valuable content and starting to do more and more collaborations with a ton of people's favorite creators. So if you're listening and you're enjoying, we'd love to have you join the Wolfpack and just stay with us. But yeah, keep rolling, Josh.
All right, we're going to move on to Twitter investors now. So what'd you buy? What'd you sell? How'd you fare this week?
Yeah, so the majority of my portfolio since about 2014 to 2015 has been in crypto. Now, this past week or so, I'm reiterating this from also last week as well. I'm still in the kind of the uncertainty phase. My hypothesis with kind of rates is sticking to it, and so with that, I've started to continue to move more and more to cash. I think for me, there's too much uncertainty right now to really justify putting in a lot of money into any of the previous positions that I have or into any of the other crypto positions I have as well. So I've continued to move a little bit more towards cash. I'm unsure when I'm going to stop that. I just want to kind of see what the Fed's going to do, what's going to happen with rates, unemployment, continue to look at those numbers. And then when I feel it's the right time, I'll strike and make sure that I'm going to be buying. Probably I'm going to continue to maybe go overweight in crypto. Depends on where rates land. But if it is higher, then I might go overweight into equity positions. So we'll see on that. Over the past week or so, I've had a bunch of different spaces on Dogecoin. I had Jay on yesterday. I had a great talk with him. And also I had a couple different spaces where I talked about Safe Moon, which I call basically the safest Ponzi I've probably seen in a while. And so, yeah, that's what I'm going to continue to look at is where rates kind of land and continue to move a little bit more cash over the next couple weeks. So I haven't really been buying anything, but I have been selling some of my positions.
Interesting. So from what I've been reading, I've heard that some investors think that rates are going to get hiked by the Fed
Right.
November as opposed to January. So interesting that you're looking at the macro picture.
Yeah.
What makes you want to go into, you could talk about rates if you want. What makes you want to go into crypto as opposed to, I don't know, maybe financials or even, gold? I know some people, nowadays just want to completely stay away from that. But,
Right.
what makes crypto attractive to you?
Well, I mean, I think what makes crypto specifically attractive to me is I've just been in the space for a good amount of time. I've been able to make a good amount of connections in the space. I guess understand the lingo, understand the people, understand the projects. And it's not to say I don't really understand equities. It's just I think there's more for me. There's more of an interest there. So when I look at things, I try to invest in things that I'm really interested in. Not so much I'm just trying to make money, but something that I almost have like skin in the game on. And so, yeah, that's really why I'm going to continue to look at crypto, and I kind of work in the crypto area as well. So it just lines up with what I want to do and what I really enjoy.
All right. Thanks, Twitter.
Yo, real quick, Twitter, crypto's getting spooked right
I know.
now. I don't know if you're watching this.
I know, yeah,
but
it's just been weird over the past week or two. Just so many different cryptic tweets from Elon and the whole gang, and so I don't know. I mean, to me, it seems really uncertain where everything is going to go, and so I'm just kind of sitting on the sidelines right now. And I think, yeah, it might hurt returns, but I'm fine with that right now for the long term.
I feel like if you hold enough crypto, you have to figure out something to manage stress in times like this.
100%.
So hopefully you've got something going on, help you out.
he vents via Twitter Space.
100%.
That works. All right. I think we'll move on to special situation.
Hey guys, appreciate the time this week. I'll try to be brief. Last week, Jonah did a great job, getting me into Upstart. But Upstart, is up 7% in the last 7 trading days. For those of you who don't know, founded in 2012 by David Gerard, formerly with Google and Apple, and Paul Gu, who won the Thiel Fellowship. It was created to create sharing agreements. Essentially, they partner with banks. They source loans and they use their algorithm to essentially figure out, apart from the score, how risky a borrower is. It's AI powered, but what's really impressive is the business has been growing with new banks. Grew revenue over 190% year over year, and I think a lot of shorts had to cover. So I've actually sold about my position, sold covered calls on 50%. If it continues to run, I'm going to sell 25% next week. But it's very rare if you've been in this business long enough to make 75% trading days. So, de-risking there, the position almost doubled in my portfolio. I also, if you guys don't follow Akram, he's a seasoned short seller. I was speaking with him last week, and did a short in Yalla. So Yalla is the clubhouse of the MENA region, the Middle East. It IPO'd in 2020 at $7.50 per share. It then rose to a multi-billion-dollar enterprise value with a couple $100 million in forward revenue. And the business, if you download the Yalla app, 90% of the people, supposed people in these chat rooms, are bots. The entire business model is gifting, and the more you gift, the more people vote for you, and then you achieve a leaderboard. So there's long-term monetization. It has 50% net margins right now because it's there's really no cost, right? To the and the gifting aspect is they take a cut of the gifting aspect, and it's not unsustainable business. They only have $250 million in cash. They announced $150 million buyback, which is just unbelievable for a growth company to take 2/3 of its cash on balance sheet after IPOing last year to buy back stock. Is absurd. So doubled my short today. It's a very good position. Again, nothing that we're saying is financial advice. And especially I do sell covered calls, but like the previous speaker, never sell naked calls. As a retail investor, I had a personal friend who was working at Deutsche Bank who blew up his account, had to sell it. His wife left him. It's very serious. Nothing here is financial advice, and anything, unless it's covered, and unless if you're, even if you're a professional, I would think twice about it, especially weeklies. So, with Yalla, at post buyback, the stock rallied about 15%, made it through the end of the day, increased my short there. Ladder, I think, is a pretty stable name for a long-term portfolio. Ladder Capital, it is internally managed commercial mortgage REIT run by the former head of UBS Real Estate. The business pays a 7% dividend yield, and it trades at a 20% discount to appreciated book. What that means is, the book value, essentially the stated value of the asset minus the liabilities of the company. This business has 68% LTV loans to multifamily residences, to commercial properties, including like Kroger, so grocery stores. It has some hotel and office. That's less than 40% of the portfolio, and it's a reasonable LTV. 99% of their customers are current. This is a reopening play. Adjusted debt to equity is only 2 turns. It has $9 in cash, so it trades at $11.50, and it has $9.90 of cash. So it's $1.2 billion of cash. It can reinvest in. It makes short-term commercial loans. All the loans are floating rate, so it's convex to rising rates. And I think that the reason why it trades at a discount to net asset value is people don't understand. One, the dividend is slightly lower than commercial peers like Blackstone Mortgage REIT, because the company raised a lot of cash during the COVID crisis, and it hasn't read, which is, as of the last earnings call, it is. Secondly, they received a very loan from the Koch brothers, very wealthy, multi-billion-dollar entrepreneurs who, opportunistically timed this in April and underwrote the loan later. That loan is about 15% of the company's capital structure. They can refinance that loan on the last call at 6%. That's 20 cents accretive on 11-cent stock in terms of earnings. I think next year they'll be able to raise their dividend to 9%. It'll trade in line. So you have 30% upside, very minimal downside, given the cash position, liquidity, and the dividend. So I like the name. It's one of my larger positions. And then I went short in a London-based company called Trainline, which I believe doesn't need to exist in 4 years by 2024 when their contracts expire. The transit authority equivalent of the UK is releasing an app where you can buy tickets at a discount, right? They want to increase capacity utilization of their metro system, just like the New York subway authority is. I made dozens of other trades, but I want to keep time limit and want to save time for questions. But it was surprisingly very profitable. I do publish a newsletter, and I have published on inflation, CPI, PPI, my outlook by each sector, by each geography for the premium. So there's a free newsletter, and then 50% of the letter that goes into sector and geographies is premium. So definitely check out the website. It's discounted right now, and just this week, Federal Reserve semester. First of all, in the April minutes, the Federal Reserve members talked about tapering for the first time. And as you recall, the Canadian Central Bank just announced tapering last month. I think it's inevitable. The Philly Fed president, Patrick Harker, who's on the board right now, he's not a voting member, also was talking today about tapering bond program sooner or later. The important thing to consider there is that the Federal Reserve is not just buying $80 billion of treasuries and $40 billion of MBS. They're actually buying $300 billion of treasuries because they're also reinvesting all the treasuries that are maturing. So on liquidity that's going into the system every month. And the Federal Reserve will not completely stop. They can't. It's like they're addicted to a drug. They will never stop the full 300 billion reinvest. But even if they taper, 10, 20 billion, right, and it comes out as a surprise, the market right now is expecting rates, to rise in 23 and tapering, 6 months before that. And at least that's what the market was expecting in the first quarter. And that's, obviously changed this month. And it will change when I think next month CPI could be above percent, as PPI leading indicator was well over 6. So, a lot of my investment, I have a big TLT short, and that to hedge some of my growth positions. But I have kind of moved into more value positions recently, and we'll keep you guys updated on this weekly Howl, hopefully going forward.
Awesome stuff, Special. I do have a
Sure.
question, actually, that you with some macro stuff. So do you think the Fed is doing a good job from like a PR standpoint? I know some people want more transparency, and also, how are you preparing your portfolio, for rate hikes or potential inflation, or do you kind of ignore that? So, how are you setting up for that?
Absolutely. So like I said earlier, I do have a TLT hedge. It's roughly 5% of my portfolio right now. The growth percentage of my portfolio is roughly 35%. So I have room to raise this TLT hedge. It's not a perfect hedge, but I will increase it as I get more conviction. Bought a little bit of gold. As a value investor, I've always eschewed gold, but I actually do think when you think of gold, you need to think about real rates. And if you kind of forecast out where at least U.S. growth is going to be versus potential inflation, I think that gold, which hasn't done anything since September, has actually rallied, 7% in the last couple of weeks. And, gold miners, copper, tin, et cetera, have gotten some exposure there. But again, on the equity side, a lot of have run a lot. So I wouldn't double down on value right now. Most of my is outright gold. I own banks. I own a number of banks. I own the regional banks. I own the KRE. I own some individual banks that I write about in my newsletter that I like, where I forecast. And I think that, those are 3 ways that you can prepare yourselves. And the most important way is have cash. So cash in the portfolio is now over 30% of my total portfolio. I can afford to do that because I'm up a lot this year. And, I think that there is a potential risk in the second half of the year for valuations to re-rate a little bit more. Growth is still robust. And as long as growth is higher than inflation, and as long as earnings estimates continue to go higher, the market could be relatively stable. But we have a lot of things, to put in perspective, right? We have to think tax hikes, right? We have to think about the infrastructure plan here underwhelming, because the Republicans are less likely to vote on that given, the economic growth here in the U.S. And we have to think about unemployment checks expiring in September. So we have, it was $600, now it's $300 a week, going to millions of people, 8% of the labor force. And that will expire, and it will force individuals to go back to work, and people will have less cash in their pockets, and they won't have the ability to day trade, right? Retail participation, 26% of total trading. I think that will come down a little bit and normalize. So those are the different things I'm thinking about when I think about capital allocation.
Cool. And final question on, from this macro perspective is, a lot of the inflation so far has been supply side shortages and whatnot, but, the ongoing recovery, now it's expected a lot of, potential future inflation would be from the demand side. Does that concern you at all?
What we've seen a lot, like you said, supply chains. I think that there's been a big, unfortunately or fortunately, I think it's good for the general population, but just from a timing perspective, the minimum wage hikes across different states. So the U.S. doesn't have, the federal minimum wage, it doesn't really apply to every state. And if the federal minimum wage is lower than the state minimum wage, and a lot of states have raised their minimum wages to $15 or more. At the same time, we have labor shortages because people have been afraid to work. There's been a lack of childcare. And Cape Cod just the other day, I've told this story before, so forgive me, but there are two young ladies who are, I was with my girlfriend, and she started a conversation with them. And what we was just for this summer, they got, in order to work in Cape Cod from Connecticut, they received $12,000 in luxury housing, so 3 months, $4,000 a month, and they received more than double their wage to work as bartenders. And that type of wage, whereas it might be temporary in nature, a lot of the wages we're seeing are going to be sticky. You can't give someone a 20%, 30% raise, especially a salaried worker, and say, hey, I'm going to take this back, because the employer is going to be disgruntled. He's either going to leave, or he or she's going to be less productive. So a lot of the inflation that we're this year is going to be sticky. Now, in the last CPI report, reserve governors and economists have said, 70% is due to base. What that means is, it's due to effects because of deflation we saw last year, hotels closing, and and I agree with that. But the wage inflation, I believe, will be sticky. What I'm keeping my eye on for the next couple months.
Awesome. I'm going to hand it over to God for a second.
Yeah, real quick, just want to say to everyone that's listening, and I think there's over 100 people listening, these speakers know exactly what they're talking about. I really recommend just, clicking into each one, looking at their bios, looking at what they've done. You just heard from Jay, works at Goldman Sachs. I'm hoping to collaborate more with him on some Howl stuff, business. We're going to hear from Francis and Uncommon and Twitter. And these are people who have studied this stuff. They spend 40, 50, 60 hours a week, creating content around this, educating people that I've learned a ton from, who have educated me through every single direction. I've done podcasts with me. So I really recommend taking a look at my speakers. Go ahead, following them. You really can't go wrong. There's a reason that they're really popular on Twitter, and they're just consistently outputting good content. So that's what I got to say with that. But let's keep it rolling. Let's roll right into Francis. Francis, I don't know if we've had you on the Weekly Howl before, but welcome to the Weekly Howl. Would love to hear from you about, what you bought and sold this week, some of your trades, and just what's going on with you.
Thanks very much, Wolf, for having me, guys. I think that was really fantastic. From special situations, I think you nailed a lot of the points that I actually wanted to talk about, actually. So personally, I follow a lot of economic indicators. However, I just don't share as much on Twitter, because I think I don't know, I think the growth community, or a lot of the investors on things with these days, don't really care about what's happening on the macro side of things, so I sometimes just don't bother, and I just share a lot of my maybe just growth stocks, related. But in general, so I guess I could just start big picture. What do I think is currently happening with the U.S. economy at the moment right now? So I think first of all, we came out of this V-shaped economic recovery, right? From the pandemic last year. And I think right now we're right into an economic boom, right? I think everyone knows that, right? From housing to retail to PPI and CPI, right? Like all across the economy is really, really doing well. And I think the funny thing is actually a lot of people are still homebound, right? Like we haven't hit that full economic recovery. Like people haven't really fully gone out and actually like lashed into the economy, which actually says what we're seeing is maybe just early signs and there could be a lot of growth ahead of us. So I think first of all, you have this economic boom that's happening. It's kind of a surprise for Wall Street in a way. And what that's leading to is inflation, right? So we know about the CPI index, right? The consumer price index, which is for consumer prices, is actually leading to prices going up, as well as on the producer side of things. So on the supply side, right, we know PPI, all of those indicators are at their highest since 2011, right? So this was after the last big recession that we had. All of these indicators are at the highest. And so obviously that's why there's huge panic. We haven't had these indicators as high as this. Though I would say inflation at 3%, 4%, which is what spooked the market 2 weeks ago, isn't anything outrageous. I mean, it's just because we haven't seen those in a long time. But those numbers are not anything crazy. So I think what we're happening now is the market is trying to decide, and I think this is what's happening. That's why you have growth performs one day, value performs another day. The market is trying to decide how much of this inflation is actually transitory or long-term sticky as special situation, man. I think that's the big debate on Wall Street right now. I don't think there's any decisive answer. The Fed believes it's transitory, and some people, lots of people, so everyone's cat to wood, right? They think it's transition. So I think that's what we're trying to decide. I honestly don't think anyone has a good answer. And I think any of us trying to say that we don't know who we have a good answer. Though lately we've seen there's quite a lot of weakness among the commodities. So lumber and some of those things are actually coming down right now. So I think what you have is economic boom, as I said earlier on. It's leading to inflation. We're trying to decide if it's transitory or long term. And now the next question that's on everyone's mind is, would the Federal Reserve have to move early, right, to tame inflation, right? So moving rates higher. And that's the next question, right? That's on everyone's mind. And no one has a good decision on really trying to see how would we actually do. Some members of the Federal Reserve, we had this week, we got some highlights from the minutes this week, right? I think the guy's name is Kaplan. He's one of the Federal Reserve's member, and he's one of those guys where they're kind of pushing Jay Powell that, hey, we need to move, we need to stop this, because what's currently happening is there's a lot of excesses happening within the housing sector, right? You could see, I think you guys have seen some of the data that shows VCs are actually purchasing houses at record rates, right? And they're just building artificially. Prices are just going up for houses, and it's also happening in Canada as well too. So I think everyone's trying to decide, would the Federal Reserve have to move early? And I think, well, let's not kid ourselves. I think what the Federal Reserves are currently doing, like the level of bond purchases is at record levels. Like this is something that what they're buying right now in the midst of an economic boom just doesn't make any sense. And I think we know they have to raise rates earlier than 2023. So anyways, so that's, we're trying to decide the rates aspect of things. But I think this has been the most interesting thing all week, and I don't know how many of you have noticed this. It's just the fact that we've actually noticed that rates haven't moved. They haven't moved for some reason. And I think this is what's surprising a lot of Wall Street actually. People expected that due to what we're seeing on the inflation side of things, the CPI index and inflation numbers, historically rates generally move, yields go higher. But I think that's very interesting, and people always say the rates markets are pretty smart, right? So I think over the next couple of weeks, we're going to get a decisive move in rates, because actually, if you look at the rates, the bonds, you'd actually see on a technical level, they're a very, very interesting level right now. And so that would be very interesting to see how they move, and that would decide how growth stocks behave over the next couple of days, So, but I think on the bull side of things, I mean, some of what I've just mentioned are all like the bear cases, but I think on the good side, we're seeing a lot of earnings that are coming quite well. I think it's over 88% or 85% right now of all S&P companies are beating. We're seeing the results are coming out really, really well. But even the earnings are coming quite straight and coming up pretty quite well. The fear now everyone has is, would a higher inflation lead to higher margins, right? And what companies are actually going to be able to successfully pass down those margins, right? And I saw an interesting data today on Bloomberg, on the Bloomberg terminal, which actually says that, I think, I wish I could show you guys what I'm looking at right now, but the Wall Street consensus estimate on margins. So margins, think about margins. Obviously, we all know the cost, right, of your employees for Fortune 500 companies. The Wall Street estimates now is actually quite at the same level at which I think it's the producer price index. So I guess I guess I won't go into the technical details of that, but what it just means is that the street is currently forecasting that a higher margins would actually push down the earnings on some of these companies in the later half of 2021. So that's problematic, because even though we're getting good earnings, well, you don't want to have those earnings being beaten down by margins as well. So I guess that's another interesting thing that we're seeing. So anyways, on my personal side of things, on a personal stock side of things, I haven't added to any stock, so I'm really cautious. I don't think we're out of the woods. So that's on a personal level. Upstart has absolutely outperformed for me. It's been my best names. But I guess what I've been doing lately is paying attention. I've just been increasing my watch list. And so names like Snowflakes, even Coinbase, if it goes down lower than 200, looks pretty interesting. I guess my goal right now is just, I'm observing and I'm looking at institutions and what they're doing, and I'm trying to find what are those stocks right now that institutions just can't sell them. There's some stocks that they're so strong, the moats, the competitive advantage of these companies are just so strong that it's institutions just feel like, boy, if I sell this, I'm going to sell this off to someone else. And I think you're seeing this with CrowdStrike, right? I just put that out in a tweet. Zscaler, Cloudflare. I'm just watching to see what are these names, because what that tells me is, once we're out of this whole mess, I don't know when that's going to be, maybe at the end of 2021, it means these are going to be your next leaders. These are going to be what's going to drive the market higher, So that's what I'm doing. I've been actually selling. Just kind of trimming out my positions, raising a little bit of cash, because I think I hate to be bearish, but I think what we've seen this week is a head fake. And I think we're not out of the woods just yet. So I guess that's all. I'm just watching inflation, the Federal Reserves, how rates move. And yeah, that's what I'm watching. So that's kind of on my end.
So to get that right, you're also holding some cash, you said?
I am holding cash. Yes, I do.
Okay, so I know 3 of our speakers have already discussed holding a decent amount of cash in their portfolio. Uncommon, you're the final speaker. Any of our speakers think cash is trash, or do we all think there's value in holding cash at a point like this?
I don't know. I mean, I just think that there's just a lot of uncertainty right now. And I'm not saying I'm 100% cash. I don't know if I'll ever be 100% cash, but I don't know. When I feel that there's more certainty, then I'll continue to deploy capital.
Gotcha.
And keep in mind, all these figureheads on TV, like Ray Dalio, when they say stuff like cash is trash, right? They're trying to get investors. They have limited partner, they have investors, essentially big pension funds that are, thinking about their allocations. And Bridgewater's returns haven't been that great recently. So, when the firm says cash is trash, they're also trying to attract capital because hedge fund managers are greedy and they want to make more. It's very rare you're gonna see a hedge fund manager, almost never, a hedge fund manager that is still, working at a top tier firm saying, hey, you guys are raising cash, because then your investors are going to say, well, then why do I need to invest with you? Maybe I should take half my cash, off of the fees that I'm paying you. So just keep that in mind when you hear CNBC, because the CNBC guys just copy whatever the sell side and the buy side guys are saying. And financial advisors always encourage investors to be fully invested, and it's really because on AUM. So I have, I actually fired my financial advisor at Credit Suisse and took in my portfolio. So just be careful about what you see.
Appreciate that insight. Love that, Jay. Thank you. All right, so I guess we'll move on to our final speaker, Uncommon. What do you buy? What do you sell? How do you fare this week in the market?
Yeah, so this week I didn't make a whole lot of moves. Obviously, I was crying tears with everybody else that has crypto. That was pretty. It was a brutal Wednesday morning. So I've started to add a position in Solana recently. For anybody that's not familiar, they're a smart contract technology. They're kind of similar to Ethereum or BNB. They're last year at the end of the year they started a relationship with Circle, which has USDC, which is one of the bigger stable coins out there. So I started positioning Solana, started dollar cost averaging in there, started a small position in MicroStrategy. So one of the things that I've tracked over time is just what the premium, what the underlying book value of Bitcoin is on MicroStrategy's balance sheet, and it's gotten to be 88% of the value of the stock. So I took a small position in that, and then I do have a fairly large position in Upstart. Just like some of the other speakers have talked about, that's just run up just a tremendous amount over the last week. I did just take a little bit off the table today, just to hedge that position a little bit. I've started raising some cash here and there, but just a really small amount. It's maybe only 5-10% of my portfolio. I don't pay tons of attention to long-term macro factors. I'm just not. I don't have the time to look into that. I think it's really interesting to hear what everybody else is having to say. I know the Feds are going to have to raise rates at some point, but when and what exactly that looks like, I have no idea. So I've continued just to buy companies I like. I added a little bit to C after they had really good earnings, and they had that really strange dip right at the open. So I did grab a little bit there, and that's run really hard. Now I'm really tempted to sell it because it ran so hard. It went, from 200 up to 250. That's just a really crazy run up all in a week. So some small moves, just trying to keep solid with my crypto positions. I think Bitcoin will continue to run hard long term. But that was a really interesting sell-off. I think there's a lot of consensus out in the community that there was some whales manipulating the price, but that's really hard to know or tell. I think what's really important for anybody that's new to the crypto space to realize is it's not possible on U.S. exchanges to really get levered up in crypto very much, but on international exchanges, you can lever up 100x. So when things go south really fast, and the downtrend can be really, really violent. So just protect yourself. Don't put any money in there that you can't afford to lose, and then just keep that perspective. Like one of the things I tweeted out earlier today is that I view Bitcoin as insurance. It's possible to have too much insurance. So just, watch your allocations, make sure you don't have too much.
Yeah, don't invest money you can't lose. I think we'd all be surprised at how many people haven't necessarily lived by those words this past year. I do want to ask, was the huge week in Upstart and C Limited enough to stop the bleeding in crypto?
No, I think we're in for some more pain. I thought we had recovered really nicely yesterday, but it looks like now we've probably dead count bounced. I watched a video. There's some folks in the industry talking about analysis of crypto and Crypto Blood. He's pretty active on Twitter and YouTube. He was saying that he's traded a long time and we always test all-time highs again. So he was saying that Bitcoin might drop to 20K. I don't know if we'll be there, but I think we drop below 30 before we start going back up again.
Is that prediction? I mean, I'm not into crypto enough to, and I don't think anybody really knows how the price movement works super well, but is that purely based on sentiment? I mean, how do you come up with, price targets for crypto?
That's purely based on sentiment. I mean, I'm a long-term investor in crypto. I think Bitcoin eventually goes way over 100K. But when is that going to happen soon? I don't know. So I've just continued to dollar cost average in, but I think people too need to prepare themselves for some potential more pain there.
All right,
If I
sounds
could add
good.
one thing real quick.
Yeah, go for it.
Just want to say, I mean, with my cash position, I mean, it's not a significant level of cash. I just wanted to make sure I clarified that earlier on. I mean, but what I do is I do have a bit of cash, but like for the most part, I'm mostly invested in the markets. And I guess all of my positions right now are positioned for the next 5 years, right? So that's the way I look at like my core positions right now are like my core position for the next. So, but for me, putting new cash to work right now, I just don't think so because I think from what I was reading, if you guys follow what's his name, Jamin Ball, he posts out Nasdaq valuations on a weekly basis. I highly recommend you checking out. So it gives a very, very good average of what's the average market valuations on tech stocks, and it's a good gauge. We're still 20% higher on valuations on the year, really. And if history is actually correct, like I've looked through the history, during a year like this, I don't think people should expect to really make a lot of money in 2021. I think people should just totally be like, hey, 2021 is just a write-off, but everyone should just be really just focused on like your horizon. Are you a 5-year investor, a 10-year investor? So I guess that's the way I'm looking at my cash position. I'm not putting new money to work now. I think we're gonna get opportunities to put more money to work. However, I'm still mostly invested in for the most part for the next 5-10 year horizon with most of my names. So I just wanted to make sure I clarify that for you guys.
I think that's a good way to look at it, Francis, where you're saying, if you just started investing last year and you probably bought some tech stocks and you're up, 50, 75, 100% on some of these stocks. I mean, that's 4 years worth of returns, right? So if we have a flat year this year, it's kind of okay, and if I'm buying anything these days, I'm buying just best of breed. I'm looking, like you said, I'm looking at 5 years, I'm looking at 10 years down the line. I'm buying the best companies, the best. I'm buying Apple's, I'm buying Microsoft. Like I'm not trying to, speculate on some of these companies like you were saying before about, that funds are going to start selling, right? So for me, I think that's going to be my approach.
Yeah, I totally agree with you, man. Yeah. And one thing I'll just add, this is a very, very interesting piece of data, and I'm lucky because I have a guy who advises lots of hedge funds and institutional funds. He actually advises them, and so I was really lucky to come across this data. So if you go on any chart, like just go right, anybody could go on your Coifin app or whatever app you use for checking out your charts. Go look at the S&P, the Nasdaq, and the Dow Jones. So after every major bear market in the history of the market, so 1947, there was a crazy bear market. 1984, the year 2000, as we all know, 2004, as well as in obviously 2009, 2010, the housing crash. Go pick up just look at it on any of those charts, and what you would see is right after the crash, right? So you had the crash right away. Right after that crash, whenever you had a huge recovery from the bottom, right? Like last year's recovery from the bottom was was one on record, but it's not really a record actually, because if you actually go back, it actually sees the same. Whenever we've had such a huge rise from the bottom, the following year, you always have a very, very, very choppy market. So actually, it was really interesting. So this guy, he's sharing this obviously with his clients, and he just shows that year two, which is usually the early stages of a new bull market, it's extremely choppy because you always have this period of digestion because it's like that first year right off the bottom, it's like boom, right? Like last year, it was so good. Once you have that, the following year is always extremely choppy. And ever since this guy, I was really lucky to come across this data. So like after I saw that, I was like, oh, that makes a lot of sense, right? Because if you go through history, year two after a nasty correction and a huge recovery, you always correction. So I guess for me, I've just when I saw that piece of data, I was just like, oh, that makes a lot of sense. And that's why I expect this whole year to be just choppy. And I just don't have any major expectations for myself. And when you don't have a lot of expectations for yourself and your portfolio, then you're just easily able to ride the wave because you already know history. So I guess maybe that was a piece of data that I came across that's just made me, I guess, yeah, I'm just pretty mellow on my expectations this year.
Yeah, I like how you mentioned, first year off the market is easy, or the market lows, like pandemic lows, it's easy. Second year, it's a lot more choppy. And I kind of want to shift that to Jay, because I know you have some experience at Goldman. Institutions, they're buying lots of funds, you know, in a choppier market where stock picking individual companies becomes, more important. Do you know how institutions kind of how do they focus their portfolios in a situation like that? And then even you could talk about your personal
Absolutely.
portfolio.
So, I mean, it's really a stock picker's market, both long and short. So this is the year in about a year and actually in about a year and a half that I've put on shorts, asymmetric that, for example, Trainline is up 28% in 3 days. And why will shorts work? A lot of the short sellers have been really badgered by the FinTwit community, and they're really doing a service to the community because short selling assists in price discovery. So if you have a company fraud that is a real fraud, or a company that has a business model that shouldn't exist, like Trainline, a company that's lying to its investors, like Yalla, about how many people are using its app, there is a real purpose for a short seller to go out there and to help with price discovery. And that doesn't mean coming out with these short reports that really hurt investors, but shorting, keeping your mouth shut and having conviction for a few quarters for everyone to recognize the truth, that is a good thing. It also helps your portfolio. Having one or two shorts can really help in a. Not only that, having some cash when valuations are high is positive, but this is really a stock picker's market. Last year you could buy anything and it went up 200-300%. This year, following really sharp, you can dig into companies and find fundamental value. One example of a name I talked about on the last call was Tip. You could buy an insurance company conglomerate that was trading at half of its value. In the last 3 months, you can pull up a chart. It more than tripled. And the reason why that people didn't realize that it owned an equity, so its GAAP earnings looked a lot than they should have been because it owned an equity and that flowed through its financial statement. But it actually generated $60 million of growing earnings from its insurance business that it was going to potentially spin out or IPO. And even without IPOing, that business has value, and that's why the stock rallied. So this is actually a stock picker's market. It's a market where just one trend, you can get blown up, right? If you just follow one trend, if you're 100% crypto, that's very risky. If you're 100% growth stocks, that's also very risky. If you're 100% gold or commodities and inflation goes the other way, that's very risky. So have a diversified portfolio and find opportunities with alpha where you're looking at something that not a lot of people know. That's honestly what Jonah did, 5-6 months ago, right? When he started coverage on it was recent IPO, no one really covered it. No one really understood it. There were growth equity guys who were in hedge funds who were in the VC rounds who knew it, and that company blew out earnings. There are a lot of opportunities that are even harder to upstart. And, really doing research is going to benefit you in the long run.
Yeah, I'd like to just say that I agree with you, Jay. I think yesterday or the day before, I think I got a message from someone saying that short selling should be illegal. We hate short sellers. And I think with the whole GME madness within the past, I don't know, a couple of months, people have had this kind of animosity towards short sellers that ultimately that they're a disservice to the economy, a disservice to the capital markets. But ultimately, that's what a lot of people forget is that they expose a lot of wrongdoing. They expose a lot of fraud, which is needed. It's ultimately needed. And yeah, I just wanted to reiterate that point.
I do have a question about short selling. Jay and Twitter, you can chime in too. If I don't know how much you short sell, but do these shorts, do they fall into your lap, or do you go out and find these companies?
Great question. So
how does that
three
work?
sources. So one is from your network. Okay, if you're as old as I am and you've built a network time, sometimes you'll have a friend who may work for a company or used to work for a company who's no longer involved. It's all public information, who realizes that there's something very wrong about the company. And in situations where specific industries all rally at once, there might be opportunities in that industry where certain companies have rallied for no reason at all, right? The second is doing screens. So I run screens on enterprise value to sales, PE, and I pick companies that, for example, have high multiples but don't have the underlying growth. You might say, right, all SaaS companies, large cap SaaS companies trade over 18 times forward sales. Mid-sized SaaS companies with, over 40% growth, trade above 12 times sales, and SaaS companies with 20% growth trade at like 6 to 8 times sales, right? But there might be some companies in there, that either that wrongfully trade at a multiple or they wrongfully trade at too low of a multiple. And if you just blanket follow people and you buy things, without actually doing the research and doing a sectional graph and, laying growth versus revenue, but just looking at revenue with some of these names, looking at EV to gross profit, EV to EBITDA, EV to forward free, if it's, cable media, EV to sub, if it's a utility, understanding the rate base, like every industry has specific metrics. And it's, you can't just do 30 minutes of work on something and buy or sell it. That I think is a misconception. You can also get research. If you need research, you can ask me. I have access to research. There are hundreds of people who terminals in research. And if you're friends with them, they'll share it with you. So that's the way. The third way, the second way is clearly to make screens. And the third way is to really know a sector well, right? People who knew the semiconductor sector well, right, in the fourth quarter of last year, or who real estate sector like me during COVID, were able to take advantage as they're happening and know, 30, 60, 90 days ahead of time what the value drivers are. Value driver is, it could be industry, could be a customer driven dynamic, could be a macro dynamic that is very specific to your industry to inflect. And one value driver, for example, in the copper industry, which is why I recently sold almost all my Freeport, was that the copper wiring that's going to go into new cars and electronics is actually increasing over time as circuit boards become more complex, cars become more complex. And it's not just the reason why copper is going up is not just supply chains or the riots in Peru or the declining dollar. Those are all drivers, but it's the fact that we're going to have more copper in our day-to-day lives, and it's an important conductor. So understanding what the values are and understanding an industry really well is a third way. So 1, work, 2, screens, 3, know an industry really well.
I just want to echo FCX.
Right.
That's a great name. Special situations. Just want to echo FCX. I own a balanced. I have a second portfolio that I own. And it's separate from my own personal core one. Just wanted to echo that piece about copper and FCX. Actually, that's my biggest position in my second portfolio because not only do you have copper, the rise of electric vehicles, and just the growth that companies experiencing and a huge secular tailwinds. I think that's a great name for anyone looking into the value sector. If you want to balance a little bit of value and growth. So just wanted to echo that from SS.
All right, cool. All right, so we just eclipsed. Yeah. Oh, sorry, that was an echo. We just eclipsed an hour, so I think I'm just going to go around to each speaker. Give them a minute or two. What are you looking at next week? It could be stocks, it could be economic indicators, anything. We'll start with you, business.
Yeah, I mean, there's such uncertainty in the market. The market hates uncertainty, and I don't know if I'm going to start any new positions next week. I doubt I will. Um, I'm like maybe 10% in cash right now, so yeah, just sort of unclear. I mean, we'll see kind of how things go, but I think there's more uncertainty ahead of us, and like we were saying before, I think there's still some downside to the tech stocks that ran up so hard last year. Just because there's sort of a yin and yang aspect to it. So it ran up so hard last year, it's gonna come down a little bit. But again, just stay positive and kind of keep your head in the game and like don't just try to cash out and just ride it out and have a long-term outlook on things and over time just bet on the market and historically it's always gone up. So if you're not trying to kind of flip stocks every other week, I don't think that's the right approach these days. Is just take a good long-term outlook and when you look back on this 5-10 years from now, you're going to be amazed that you were buying Apple at 120. So I think just keep it in perspective and zoom out and just kind of keep the faith.
Awesome. Jay, what about you?
Hey guys, so next week I actually have some good news. So I run a family office, my top priority, and my other focus is financial education. And I hired an analyst from a bank that I used to work at to build my company. And with respect to my newsletter, I've had a pretty increasing a great jump in my newsletter subscriptions. It's normally $50 a month, but it's $10 a month locked in for anyone who signs up now. But I'm also giving away, now that I've hired an analyst, a free 3-statement model on any large cap company with a 1-week lead time. He needs to build a model for anyone who signs up. So, just let me know ahead of time. Signing up, you can DM me. I would like a model on Apple, or I would like a model on iPhone, or I would like a model on Salesforce, and it will be a full 3-statement model with valuation. You can go to my website, specialistresearch.com, sign up for, I've lowered the price, the $10 weekly subscription, and you can ask me for a company with a lead time. Next week, I'm focused on assessing, various macroeconomic indicators, and I'm looking to build my inline and Yalla shorts. I'm also running a screen on value names in the consumer sector, and I'm going to be looking at a company called DoFree. And DoFree it's a monopoly. It's one of the largest duty-free stores within airports, and they have 6-year contracts with airports. And as travel increases, as COVID is, right now in the U.S. we're vaccinated, over 50% vaccinated, but as other parts of the country get up and running, airport traffic, the TSA, I think hit a record last week. Airport traffic is going to be, I think the airlines are overvalued. And I had big positions in the lessors like AirCap, which did really well. Those are fair valued now too. I think the next big name to rally in the sector is DoFree. So I'm doing a lot of work on it, and we'll share something over the next couple weeks.
Sweet. What about you, Francis?
Oh yeah, I think for me next week, I'm watching the Nasdaq. So this week we got a pretty good recovery this week, as you guys could see in growth names. Particularly lots of recovery this week in growth names. So next week would be very, very important. I think it would be extremely important to see, are we going to hold those gains, or was this week just a head fake, right? So I guess that's one thing for me that I'm going to be watching quite closely over the next week to see what the market is maybe deciding. Maybe the market thinks inflation is going to be transitory or not. Maybe that's what people are getting. So that's one piece. And then right now, I don't think there's much. I mean, for the most part, as I said, I'm just sitting on my bots. I'm doing a lot of research in the market. So I'm just wrapping up a thread on, I'm doing an analysis on Cloudflare and Fastly. And I'm also doing a lot of research into the gig economy on Fiverr, Upwork, as well as SoFi, a fintech company. So over the next couple of days, I'll be sharing some of that research on my Twitter page and just sharing some of my research. So that's, I guess, for me, 2021 is just a year where you got to do research, you got to be patient, and just this year is all about finding what are those names that are going to be the next generational leaders in the growth market for growth stocks. What are going to be those names that are going to lead over the next decade? And that's what I'm focused on. And bless, I guess, word on volatility. So
Cool. What about you, Twitter?
Yeah, so this upcoming week, I'm going to be focusing on moving a little bit more into cash. Continue to look at the uncertainty and hope for some certainty in certain areas that I'm looking at. And then I'm going to continue, it looks like not tomorrow, but over Sunday, I'll be having at least one space with a VC. And I want to continue. And also, I guess later today, I'm going to have one in about 30 minutes with a VP at Goldman Sachs. And then also later today, a cannabis executive. And then next week, I want to continue to have these kind of more structured, kind of like Wolf does, or you guys do, where it's more structured talks or spaces, and get kind of backgrounds from a bunch of different areas, see where they think about the economy right now, what they're investing in, what they're selling. And yeah, that's what I'm going to be doing over the next week. It's going to be fun.
All right, and Uncommon, we'll finish with you.
Yeah, I think for me, from a stock perspective, I'll probably just continue to sit on my hands, continue to accumulate new cash, and then I have a daily recurring buy of Bitcoin. The price is attractive right now. Like I said, I think we do see some more pain, but I'm just going to continue to dollar cost average in and continue to hold there.
All right. Before I end the space, big shout out to all the speakers, Business, Jay, Francis, Twitter, Uncommon. Please give them all a follow. These guys are providing a ton of valuable information via Twitter. A lot of them have links in their bio to further research. Jay has a newsletter. Business has some books. Francis has a Substack. Uncommon has a link tree. So be sure to check out their bios, give them a follow, and support these guys. And also big thanks to all the listeners tonight. Thanks, guys.
All right, everybody. Take care. Have a great weekend. If anybody's interested, I'm really hoping my voice. This is Gav again. So that was Josh at Josh_Meltzer. He's in the crowd here. You can check him out and give him a follow. I was invited to speak tomorrow on finances in relationships at 2 p.m. EST. I'm not in a relationship, and I've never done finances in a relationship, but I said I'd give it my best shot. So I'm going to try that as long as my voice is good. If not, it'll be Josh, who's also not in a relationship and his thoughts on finances in a relationship. So you'll come see us struggle with that. And then, yeah, planning some stuff for next week, hopefully with maybe Francis. We'll do something with maybe Muji for Snowflake. Got some stuff I'm working up with possibly Ramp Capital and a couple of others. So definitely, keep in the loop, everybody, and have a great rest of your Friday night. Go enjoy yourselves.